So indexing has been pretty popular lately, especially in the past few years. And you even have some of the big people out there saying that index investing is great. And you should invest in maybe an S&P 500 index ETF and just hold on to that. And now the S&P 500 index fund, some people says it returns around 12% a year, maybe 10. And it's hard to say because it all really depends on on when you buy into the index ETF. And so, I mean, if you buy in at the top, if you bought in 2008 at the top, or if you bought in I don't know, 2001, then the returns are obviously going to be different, uh, you know, to where they would be if you had bought in 2009. And I just saw a graph showing the Berkshire Hathaway versus the S&P 500 annual change over the past 20 years, and it's kind of measuring the returns of both Berkshire Hathaway, which is Warren Buffett's, I guess, asset holding company, versus the S&P 500. And really, Warren Buffett hasn't done too well in the last 20 years compared to the S&P. And over the past 20 years, the S&P Warren Buffett only made 2% higher than the S&P 500. Now that's pretty good, and 2% is quite a lot, especially when you're managing hundreds of billions of dollars. But in the grand scheme of things, it's not anything too crazy, and especially since it's more the recent years where the value investors in 2019, 2020, and of course this year probably as well in 2021, but 2001 also. It's the kind of the hyped up stocks, the stocks that are just getting all the hype, the technologies, and you have some really dumb investments, especially made by the retail investors. And so the value guys don't do as well during some of the more bubbly years. And so that's why you see Berkshire losing compared to the S&P 500 for the past 2-ish years, but to a degree that hasn't really been seen ever since the late 1990s, which was leading to the tech, the bursting of the tech bubble. And so my point is that, a lot of people say indexing is great, but at the same time, I think a problem with indexing is, if you look at how many people have been jumping into index funds, if you look at how many people are jumping in to the ETFs, there's a lot of people, and I think a problem with the ETF is that you have, quite a lot of overvalued companies in the S&P 500, and I'd say Tesla is one of them. But at the same time, it's full of a lot of, better value and more conservative stocks as well. Now the problem, I think it would be a great investment for someone who, doesn't know much about stocks, about, ways to invest, and someone who really doesn't have a better way to put their money at work. I think for them it would be great. But for somebody who is more knowledgeable about the stock market or real estate, I guess that works too, or other types of ways to invest capital. So maybe someone who's more familiar with, let's say, macroeconomic cycles or just individual stocks, and how to invest. Then I think for those guys, it's probably not the best idea to put their money in an S&P 500 index. And you see a lot of people now, I mean, I think they have seen the past returns of the S&P 500. And so I think something that's happening right now is that you kind of have this, it's like people jump into the index because they look at its past performance, and then that pushes up the index. And then the index goes even higher, and you get the same cycle. But the problem is, I guess you could say the earnings haven't increased significantly. And that's the case with a lot of companies, especially the more exciting companies that stand out to the retail market. And the market cap of the S&P 500, so it's $31.6 trillion. So all of the companies inside is worth 31 or maybe around 33 trillion. So you're not going to be investing in things that, let's say, are going to grow a lot. And that's an opportunity you have if you're not so incredibly diversified, that essentially a gain on an individual company doesn't affect your portfolio at all, really, unless if it's a company like Apple, or Google, or Facebook. Because, I mean, those are the only companies that will actually impact your portfolio. Now, the problem with these companies is the bigger they are, the more they take up of your S&P 500 index fund. So you're getting the big companies that don't really have much of an opportunity to grow much. You know, it could still grow maybe 5% a year, depending on whether it's already overvalued or not, and depending on, let's say, what the cycle is like, what industry or sector will do well in the next few years. But it's a very clueless way of going in. Now, the good thing about it is you don't have to worry about what happens. You don't have to try to find, first of all, it's completely the opposite of day trading. And you don't have to be up all day, up at night, and losing your sleep and losing your hair at 30 years old. So you get to avoid that, which I would actually probably prefer because I don't want to lose my hair. But another, positive compared to day trading is you don't have to pay all these fees. And also, I mean, most day traders lose money anyways, so and most indexers over the long run make a pretty modest return, not a large sum of money, but just, it's a reasonable sum of money for not having to do anything other than putting money there. And so for someone who's not really familiar, again, I think it's a pretty good way to get a small return, put your money to work. Probably not the most efficient way, but it could work. And comparing to a mutual fund, of course, you don't have to pay fees. Now, the right mutual fund will do better than the index, but the wrong mutual fund will not do better than the index. And so if you're going to pick a mutual fund over one of these index funds, then you have to be sure you're picking the right ones. And of course, you have to kind of understand cycles of sectors, of interest rates, and you have to kind of look at where the debt is going and how the market is valued. Is it overvalued, undervalued? What sectors are undervalued, overvalued? And that's kind of how you have to play if you're going to go from mutual fund to mutual fund. Because some years, and it's usually not just 1 year and another year randomly, it's usually over a period of a few years, some specific types of mutual funds do well. So you have some years the tech mutual funds do well, probably the last few years, last 6-7 years or so. And then you have, sometimes the value companies do well, sometimes the growth companies do well, sometimes the commodity mutual funds do well. And so you have to kind of do a lot more research if you're going to buy a mutual fund. You have to look at the fees, you have to look at its past performance, you have to look at its management. And so you're going to have to put in more work, and you're going to have to know more if you go for the mutual fund. And the good thing about a mutual fund is it's still a lot easier than individual stock picking. It's still a lot, you save a lot of time. And you're quite diversified if you like diversification. I guess you're usually quite diversified, unless if you buy Warren Buffett's company. But Warren Buffett's Berkshire he says he doesn't like diversification. Berkshire is pretty diversified. Now, it's not like super diversified. It's not like Ray Dalio, it's not like Bridgewater. But it's still, he's got a few companies in there. And in fact, he's so diversified that I just searched up how many companies he owns, and Warren Buffett, through Berkshire Hathaway, owns 65 distinct companies, which are divided, into a complex web of over 260 subsidiaries. So, think of that. And I think. I don't think diversification is the most important thing. I think it's a pretty important thing. But he says he doesn't like diversification. Berkshire owns 65 distinct companies. That's pretty diversified. I think that's probably more diversified than you need to be. Now, I think the more money you manage, the more you should be diversified. But still, it is a way to diversify if you get into a mutual fund most of the times. Now, I'm not going to go into whether or not you should diversify, but I will go into what are the options. What are some reasons why you might want to go for index funds, and some reasons why you might not want to. And I've just talked about some, but I want to go on a little bit deeper about some of the other reasons. And I think one specific reason is that investing in the S&P 500 is you're going to be investing in the United States. You're going to be betting on U.S. companies. Now, I hate to be, I guess you could say pessimist, but I don't know how the U.S. is going to do in the next 20, 30, 40 years. Because, there's quite a few reasons why. And first of all, you look at the amount of zombie companies that are around now. And I think a lot of estimates say it's around 20% of US companies are zombie companies, meaning companies that don't make enough money to pay back its interest on the debt. And so, I mean, you're basically going to have to borrow money to stay alive. Not even to make a profit, but just to stay alive. And of course, obviously, that's not sustainable. And I'm sure the S&P 500 holds a few of those companies. And I think if we keep on bailing out businesses, giving these PPP loans, giving consumers all these free money, all the stimulus checks, we're just going to have a lot more of these zombie companies, and a lot of them are going to crawl into the S&P 500. And, I guess good companies are being punished, I guess, because they're not being bailed out. And so they're not directly being punished, but their competitors, the competitors are getting away with it. And so helping a good business's competitor stay alive when it shouldn't be alive is, indirectly punishing the good businesses. And so you really don't know how the future of the United States is going to be like and whether it's going to do well or not. Because, a lot of people say, well, if you look at history, the S&P 500 has been around for a long time. So if you look at history, 12%, 10%, whatever you want to call it, return every year. And so we're going to make more money forever. But the problem is you're only making money if the U.S. is going to do well. And, I think that the fast-growing years of the U.S. is far, far gone. Now, you could argue that 2019, 2020, 2021, especially after March, we've had tremendous growth. The economy's booming. Look at where the S&P 500 is now. But that's not a reflection of the real economy. That's a reflection of the stock market, of asset prices. But the real economy is not, it's nowhere as good as where it was back in 2019, I guess you could say. And compared to where, how fast it was growing, at least in 1960 and 1970, right now we're going so much slower. And I guess one thing is because we're not innovating nearly as quickly. Another thing I'd say is because, government has distorted the economy in so many ways. And I think I guess in some ways, to some extent, it's just we let foreigners do the dirty work, and so we don't really have to innovate. But eventually, when foreign wages go up, we're going to have to innovate. We're going to have to find better, faster, more efficient ways to produce things, to do whatever things. But we don't have that problem immediately right now. And so, but back to the point is that the future of the United States, I don't know if it's going to be necessarily the best place in the world, because we're getting more and more socialism, we're getting more and more government intervention, and if you look at history, that that's not something that supports a good economy. And moving on, it's just hard to tell where the U.S. economy is going in the next 50 years. And I'd say another really difficult thing is that you don't know what is the better alternative, because historically the U.S. has always been the best alternative for whatever other country people are from. But nowadays, the U.S. is looking kind of, maybe not not like such a good long-term investment anymore, especially if you want to get rich. And so, I think if you're just going to go into the S&P, you're missing out on a lot of let's say foreign investments that could do much, much better than American investments in the next couple of decades. And so I think you can't always bet on America, because if you look at, world countries throughout history, they have their own ups and downs. And if, maybe over the next 200 years, America is going to come back. But, well, it would be cool if you lived for 200 years. But if you can't live for 200 years, well, it doesn't matter if, in the long run, America does well. Because, I mean, you're still not going to get the money you want if, America, becomes better than every country to a degree unimaginable 200 years from now. It doesn't matter. It has no impact on you and I, unless if we somehow live, to be that old, and that would be cool. If we did live that long, then I think we would do much better picking individual stocks, as long as you know how to, as long as you're, I guess you would say, knowledgeable in the field, you're willing to put time in the field, you're somewhat talented in the field, then I think it's way better than buying just an index fund of the S&P 500 or whatever index fund you want. Because although you're going to be getting probably some decent steady returns, you have a lot of pretty good companies in the S&P, but you also have a lot of terrible companies, overpriced, overvalued companies in your ETF. And so I don't think it's a great idea if you know what you're doing. But if you just want to retire, you don't want to spend much time researching, and you don't want that much stress, and you just want it easy. You want maybe a 5% return every year after inflation, because if you're going to take in CPI numbers, I don't know if they really reflect real prices, but let's assume they do. Then, you're going to be getting around 7% after inflation real return. If you take a 9% return or a 10% return, it depends. But I would say indexing right now, I would avoid indexing right now. I think right now it's at least in the short term right now, it doesn't seem like a very dangerous period, at least within a few short months. But I'd say in a year or two, that's when you have a lot more dangers. That's when, look how long-term interest rates are rising right now. Now, how much higher will they go before the Fed begins to lower them? At least how Jerome Powell claims that he will lower them. So, where are they going, and when is he going to let interest rates rise? And when are we going to just no longer have any more stimulus, fiscal and monetary? It's hard to say, and I'd say in the medium term, 2-3 years, maybe 1 year, but 2-3 years is a better bet. I think things could get pretty bad. I think at least the markets could. And so I would avoid the ETFs of index funds and these S&P 500. I mean, I think just investing in good, stable companies with, I think I'd take a more defensive approach right now. Just dividend paying companies. I think with the ability to change prices in whatever situations, those are the companies that would probably not necessarily have the highest returns in the next 2-3 years, but I'd say take the least damage from maybe another crash in the next 2 or 3 years. And so you could convert them to cash if you find a better, cheaper opportunity. Because right now there's not really there's not many good opportunities to invest in. The market is quite expensive right now, and it's a higher risk, lower reward environment. So I think I would stick with dividend paying, more conservative, lower debt companies. Maybe a few, maybe actually quite a few companies outside of the U.S. Probably most companies outside of the U.S. I think some companies in the U.S. is fine, but I'd take a lot of my companies outside of the U.S. I think maybe natural resources could do quite well because those guys could certainly benefit from more monetary and fiscal stimulus. And an index fund, if you're planning to hold for 50 years, sure, go for it. Maybe America is going to do great in the next 50 years. But I think it's better than holding cash, first of all. And second of all, I think that the index fund will not yield the same return it has in the next 50 years than it has in the last 50 years. And I think it will be a lower rate of return.